Friends, there was a popular Hindi movie song from the 70s, Na Mangu Sona Chandi, Na Mangu Hira Moti. The songwriter further states, Ye mere kis kaam ke hain? Goodness gracious me. Was the songwriter trying to give investment advice through this song? And is it a good advice? Well, in this video, we'll explore whether investing in gold or silver is a wise decision, as well as whether such investments have any correlation with the stock market, particularly Nifty. Is it possible to somewhat time investments in gold, silver or the stock market based on their correlation, if any? Stay tuned, I'll show you a very interesting correlation pattern in this video that may provide some food for thought on improving the returns of your long-term investments and may also change your perspective. This video, however, is subject to certain disclaimers specified at the end. Hi, I'm Vineet Jaiswal. Welcome to my YouTube channel. Before I proceed, please hit the subscribe button and support my channel. I promise to continue sharing useful information with you. At the outset, let me try to end the debate on which of the three asset classes has given the highest return in the long run. Please see the comparative monthly chart of gold, silver, Nifty as well as Dow Jones, which is a US index, since 1990. A small clarification, 1990 was the base year for Nifty, although Nifty was formally launched in April 1996. For apple-to-apple comparison, all four are denominated in US dollars since gold is largely imported into India in US dollars. The CAGR return for gold, silver and Nifty, all in US dollars, has been around 5.9%, 5.6% and 9% per annum respectively. Clearly, Nifty has outperformed gold and silver. The same is true for Dow Jones, which has also significantly outperformed gold and silver with a CAGR return of 8.5% per annum. We will return to this chart a little later when I discuss a pertinent observation about the correlation and how our investments in these asset classes can be timed more effectively to achieve better returns. However, to arrive at a reasonably correct conclusion, we need to look not only at the comparative chart but also the standalone chart. Now let's look at the standalone chart of gold in US dollars. Clearly there was a period of consolidation from July 2020 to about February 2024, and now gold prices have broken out of that consolidation. In fact, from the high of August 2011 to February 2024, there was hardly any return from gold in the international market. On August 6, 2024, when the price was $2,412, I had shared my views on Twitter about gold potentially hitting at least $3,200 in few years. As on date of this video, the current price has appreciated by more than $200 to $2,621. In India, gold futures prices in INR have been in a consolidation phase at times and have given a CAGR return of 10% per annum. While internationally during the same period, gold in US dollars has given a CAGR return of 6% per annum. Please note that gold prices in India are largely affected by two major factors, although festive seasons have a minor impact. The two major factors are the international price and the exchange rate of Indian rupee to US dollar. So if the international price moves up or down, gold prices in India will adjust accordingly. The rupee's depreciation against the US dollar has been around 4% per annum, which also contributes to the inflationary trend in gold prices in India. In simple mathematical terms, the gold price in India is equivalent to 6% CAGR return internationally plus 4% per annum rupee depreciation against the US dollar, resulting in a CAGR return of around 10% per annum. In any case, we can see that gold has beaten inflation and has historically outperformed fixed deposits in India. However, unlike fixed deposits, gold prices also correct from time to time, so there could be a year or two when there would be negative returns from gold. For example, in 2021, gold closed 4% lower than the previous year's closing price and had fallen by 12% at some point during that year. Despite the volatility in gold prices, the mindset of Indians refuses to give up on gold or silver jewelry. From an investment perspective, jewelry and other forms of physical gold are the worst forms of investment. Please keep in mind that there are costs associated with the safe custody of physical gold. In my opinion, investors in gold should always consider digital forms which eliminate the need for physical custody. Popular options in digital forms are gold ETFs like gold Bs or sovereign gold bonds issued by the government through the RBI. Please see the comparative chart of gold futures, gold Bs and sovereign gold bonds. Among these, sovereign gold bonds are clearly the winner. Another significant advantage of investing through ETFs or sovereign gold bonds is that they can be bought or sold at any time on the stock exchanges at the prevailing price with a transparent price discovery process. Next, let's look at the international price chart of silver in US dollars. Silver is in a long-term consolidation phase. From its peak price in 1980, there has hardly been any return in the past 44 years. Though the peak price of 1980 was broken in 2011, the current price of $31 per ounce is still below its all-time high. Once it breaks out of its consolidation, we can expect a massive bull run with likely targets of $60, then $100 and $120 in few years post-breakout. In the comparative chart shown earlier, silver has been underperforming the others, so there's a possibility of a period of relative outperformance by silver in the coming years or decade. Silver has historically been more volatile than gold, but both gold and silver are considered safe haven assets during economic downturns. Like gold, it makes sense to invest in silver through its ETF rather than in physical form. One drawback is that, unlike stocks or Nifty ETFs, both gold and silver ETFs slightly underperform their futures counterparts, likely due to the expense ratios charged for ETFs. Furthermore, gold and silver themselves do not generate income, so there's no dividend component adding to the value of the ETF. In contrast, Nifty ETFs, due to dividends from their constituent stocks, slightly outperform the benchmark Nifty, and this outperformance may increase over time. Let's return to the comparative monthly chart of gold, silver and Nifty, all in US dollars, to see if there is any correlation and whether we can improve returns by investing in these three assets, namely Nifty, gold and silver. First and foremost, many believe there is an inverse correlation between Nifty on one hand and gold and silver on the other hand. However, this is not entirely correct. In the long run, all have provided positive returns. However, there have been periods when some sort of inverse correlation can be observed, specifically during economic downturns when there has been a massive fall in the stock market. And gold and silver have delivered not only positive returns but have outperformed Nifty hands down. The most interesting correlation pattern that can be seen is the periods of convergence and divergence of Nifty with the other two assets, which keeps repeating. There is no reason to believe history will not repeat itself in future. In the periods following the convergence of all the three, Nifty has outperformed gold and silver. Conversely, during the periods of extreme divergence of Nifty relative to the other two assets, we can observe significant corrections or fall in Nifty, while the other two assets have yielded handsome returns until they sort of converge again. Currently, we can see a significant divergence of Nifty from the other two assets. So a prudent investor would gradually start allocating more funds to gold and silver and may also book some profit from Nifty to rebalance their investment portfolio. It's never a good idea to completely exit any of the assets. If some investors do not want to keep track of periods of convergence and divergence, they should consider allocating 50% of their funds to Nifty and the remaining 50% to gold and silver. This simple allocation with occasional rebalancing to ensure equal distribution has yielded very good returns with reduced volatility and drawdown compared to an allocation solely to Nifty or just to gold and silver. With that, I'll now end this video. I hope you found this analysis useful. Once again, I'll request you to extend your support by subscribing to my channel in case you haven't already. Also, kindly hit the like button and share this video with your friends and family. If you have any comments or questions, let me know in the comment section below. Thanks for watching and I'll see you in the next video. I'm not a SEBI registered advisor or analyst. This video is only for educational purpose. Stock market investment and trading entail risk. It is advisable that you should do your own due diligence and analysis before investing or trading. Discussion about any share or other forms of investment during this session is not a recommendation of any kind, and I may or may not have positions in such investment or shares. Past track record is not a guarantee for future performance. Information, stats, research results shared during this session are not entirely mine.